Good morning, everybody. Welcome to the Centralized Joint Forum for the Sanlam Umbrella Fund. My name is Abdul Kasim. I'm a Client Relations Manager at Sanlam Corporate. We've got a jam-packed agenda for you today, and it will be an important session to cover some pertinent topics with regards to happenings around the fund, as it will be presented shortly. The most important, one of the item for discussion is with regards to the annual revision date for the Sanlam Umbrella Fund and the Sanlam Unity Fund. Basically, what's happening is the revision date has been moved forward from April to August, meaning that the next annual revision will take place on the 1st of August next year. So the reason for the adjustment is just to ensure that current administration fees and insurance premiums will remain unchanged until the 1st of August. The primary reason behind this was that the previous revision process coincided with the holiday season, which often resulted in limited availability of resources as well. So the timing created challenges for effective management and the effective management of the responsiveness and queries that were raised as a result of the holiday season. So that this new strategic change basically aims to improve our operational efficiency and, more importantly, to increase client satisfaction. Okay, moving on to the next agenda item is regarding the comprehensive critical illness benefit, which is offered through the Umbrella Fund. Okay, so basically what has happened is the current critical illness benefit has been replaced in the form of an enhancement to now be a more inclusive, comprehensive critical illness option. So previously, the members were covered under a very limited product offering, whereas the comprehensive option now offers members protection and cover to a more broader and wider range of illnesses that they can claim for. This offering is available with both the approved insurers under the Umbrella platform, being Sanlam Group Risk and ABSA Life as well. Okay, so basically the benefits typically included conditions, the comprehensive benefit typically includes additional conditions which are covered under the standard option. And like I said, it basically offers greater financial security to our members during serious health events as well. Okay. Then we go on to the annuity strategy review. Okay, so this was with regards to the in-fund living annuity. So the Sanlam Umbrella Fund has completed a review of the default in-fund annuity strategy, and the key change is that the minimum has been increased in terms of member share from 100,000 Rand to 500,000 Rand. So basically what this means is that in terms of the adjustment, the strategy, if members have got less than 500,000 Rand as fund credit at the point of retirement, they will then be directed to purchase an out-of-fund guaranteed annuity. If a member has a member share of 500,000 Rand or more, they can opt to have the trustee endorsed in-fund living annuity and also have the extended in-fund annuity range offered to them, and also at the same time be able to also select an in-fund out-of-fund guaranteed annuity as well. So basically the change reflects the fund's commitment to improving member benefits and ensuring that individuals have access to a more inclusive and robust coverage as well. Okay, and basically this update basically positions the fund competitively in the market and demonstrates our focus on members, and more especially their well-being and long-term value offering in terms of the in-fund products that are available. Okay. We then move on to the next point, which is with regards to the Unity Umbrella Fund, and more specifically in terms of the investment strategy review. So initially, the fund had opted for an investment strategy to direct basically 10% of all ongoing contributions into the SIM enhanced cash portfolio to enhance liquidity, specifically for the two-pot withdrawals, which came into effect on the 1st of September 2024. This was just make sure that there was sufficient funds available to cover all the claims that were submitted by those members. We are pleased to confirm that the board has basically done a full review and have now reduced the cash allocation of ongoing contributions to 5%, which basically balances the needs with the liquidity needs with the long-term growth strategy of the Unity Umbrella Fund. Okay, and basically this tiered approach basically offers flexibility and alignment with best practices for retirement planning, ensuring that our members receive appropriate solutions based on their accumulated savings. Okay, we move on to the member channels. In terms of member channels, there are quite a few knowledge bases, and also more importantly, first is with regards to the member app or the member portal. So the links will be posted in the chat as well. And basically, members are able to access the Sanlam member portal and instantly be able to have a view, an overall view of all the investment products that they have with Sanlam, specifically the Sanlam Umbrella Fund and Sanlam Unity Umbrella Fund. They are able to go through some functionality such as updating their beneficiary information. Also for those employees or those members who would like to go through and submit investment choice portfolio changes, those can all be done online via direct engagement between the fund and themselves as well. So the members are able to then, like I say, self-register. And also one of the features of the member app is that for those members who would like to submit their two-pot savings claim, as has been happening over the last year or so, they can do the claim submissions directly via the portal or the app to Sanlam. And then once successfully submitted, the two-pot savings claims are finalized within a maximum of 10 business days. Okay, then we have the Sanlam knowledge base, which is basically has a host of information, and some of the items included there is links to view the previous Imali Sam member sessions and a whole host of more information that's available to members for their perusal as well. We've got the details displayed of the Sanlam member contact center. Okay, so members are free to contact the call center at any given time during office hours. They also have the option of chatting to an agent live during office hours via WhatsApp. And if they even prefer, they could also send an email directly to the Sanlam call center or the contact center. And one of the agents will respond to them within the stipulated turnaround times. We've also got the contact details displayed for the retirement benefit counselors. And these are in terms of, for any members who require guidance with regards to time benefit, counseling, or even perhaps maybe just factual information in terms of what options are available to them. So that there's a toll-free number that they can use to contact the retirement benefit counselors. They can send a free SMS to the counseling team, and then the team will contact them, by way of return phone call. Alternatively, they could also send an email address to the ims@sanlam.co.za email address, and then one of the counselors will get in touch with them. So that's basically just the first session, first part of my overview thus far. We move on to a little bit more of a complex discussion with regards to customer due diligence and Section 13A compliance. So basically, the concise overview we're going to do is now just with, like I said, the two critical components with regards to legislation as well. So customer due diligence under the FICA Act. And Section 13A compliance under the Pension Funds Act in South Africa. So CDD is basically a foundational element which assists us in combating financial crimes, which includes money laundering and terrorist funding. So the process involves us in verifying the identity of our clients and assessing their risk levels as well. Section 13A, on the other hand, basically mandates employers to make timely and accurate contributions towards the fund for their employees in terms of deductions made from their salaries. So ultimately, understanding and adhering to these regulations would basically allow us to maintain trust, and also, more importantly, to be legally compliant, and also to maintain our financial integrity within our organizations that we deal with each other as well. Most importantly, why does compliance matter? So basically, compliance, the main thing is, again, as I've said, it helps to prevent money laundering and terrorist financing through customer identification and verification, and also a risk assessment. So one of the other things is that the fund continuously ensures compliance to the CDD requirements. So there will be times when clients are requested to submit their updated CDD requirements. And through your assistance, we do require that, if you could please ensure that the respective employer contacts also do respond timeously to our requests for those information. Okay, and basically the biggest thing, as we said, is that this entire CDD process allows us to know our clients better and to detect any suspicious activities, and more importantly, to maintain compliance with anti-money laundering and counter terrorist financing regulations as well. Okay, then with regards to the onboarding, okay, in terms of the requirements as well, we have to do a verification process to make sure that we are dealing with legitimate individuals. Okay, and the risk assessment, as I said, is basically ongoing and it continues throughout the life cycle of our relationship with our clients. Okay, so there is ongoing screening. We continuously monitor transactions to identify any unusual or suspicious activity. And most importantly, it allows us to update our customer information and reassess the risk profiles linked to our customers as well. So again, once again, as I said, documentation is requested on an ongoing basis where we do find a need for us to update our records. And again, please, clients are required to please ensure that documentation is submitted promptly to ensure that we maintain our ongoing relationship with our clients. Then we move on to the Section 13A compliance. Okay, so with regards to Section 13A, ultimately this is governed by the Pension Funds Act in South Africa, and the Act defines or confirms that contributions must be paid into the fund's bank account and reflect in the fund's bank account by the 7th of the next month after which they become due. So as an example, the contributions for the month of November need to be in the fund's bank account by the 7th of December. Okay. Also, employers are required to submit contributions or the contribution information by the 15th day of the next month. So again, an example, the November contributions will be due to the fund by the 15th of December. So in the event of non-compliance or late payment of contributions, that failure of meeting those deadlines would mean that the fund has to charge interest as a penalty and possibly institute legal action against employers. Excuse me. In terms of the interest penalty that's charged to the employers, that is basically in terms, again, of Section 13A of the Pension Funds Act. And often this discussion comes up with clients who do pay late, where they actually request Sanlam to waive those penalties. Unfortunately, in terms of legislation, it's not Sanlam's rule, it's a legislative rule that we have to charge those penalties. And once those penalties are charged and paid over by the employer, those are then allocated onto the respective member records in proportion to their contributions as well. Okay, so also in terms of record keeping requirements, employers need to ensure that they maintain proper records and systems to ensure compliance with the Act and obviously avoid any potential issues with regards to the pension fund contributions. Also with regards to a requirement from the FSCA in terms of minimum information and the consequences of not providing the correct information. So the FSCA has issued a directive whereby it's called the FSCA Standard Conduct, FSCA Standard Reporting, and ultimately the new reporting compels the employers to provide us with full names of all the members who appear on a contribution schedule. We need their full ID or passport numbers, their contact details such as their mobile numbers, email addresses, and addresses, and obviously the salary and contribution amounts which need to be included in the monthly reconciliations. So just perhaps maybe just for comfort purposes, the contact information specifically, which is also shared with the fund, is not used for any other purpose except for reporting to the FSCA that employers are compliant in providing all supporting information. In the event of employers not providing the complete data or inaccurate data, it could potentially cause a delay in terms of allocation of contribution. And at the same time, we need to also report back to the FSCA in terms of employers being non-compliant. Okay, so it's quite important in terms of our ongoing requirements to meet legislative requirements that we do get the buy-in from our respective employers. And like I said, the reporting would happen where employers do breach on that. For those clients who are using the Sanlam online contributions process, that the requirements are pretty much highlighted as part of the online submission, and one of the system will flag any missing information prior to submission of a specific bit of information that's not included on the data. Okay, and then that's basically just with regards to the CDD and the Section 13A requirements, and we will now move on to some additional information that's available to yourselves as joint forum members and also available to members as well. So We have a platform called the Consultant Toolkit, and basically what happens is when you do access the Consultant Toolkit, you would need to select the icon on the bottom right-hand side of your screen, which refers to the Joint Forum Pack. Okay, once you select the Joint Forum Pack, you will be able to then view the most recent Sanlam Umbrella Fund Trustee Report, which is the current report as well. And then also we have additional reports which refer to the quarterly investment report to the Joint Forum to yourself. So to navigate to the quarterly investment report, you simply would just scroll down on your screen and ultimately select the quarterly investment updates to the Joint Forum and then download the applicable report per respective quarter. So the most recent report that's available is at the top of your page, then that would be referred to Q3 and has a full summary in terms of the investment information relating to all the portfolios it's available on the Umbrella platform. Okay, we then also in terms of that's basically with regards to the to what's available on the Sanlam Umbrella Fund Consultant Toolkit. And then we also move on to now to the last bit of information in terms of what's available to members on the online platform or to employer users. So we do have the Sanlam Employer Portal. Okay, and under the Sanlam Employer Portal, for all the registered users, there's a whole host of reports which are available. So we do have on the right-hand side of my screen, towards the middle of my screen, the downloads option. There's quite a bit of reports which can be extracted. The member data report, all of these are in Excel spreadsheets, but member data provides you with a detailed description of all the membership information that's currently on record on our side, together with the details of how much of money is or what particular values each of those people have as well. There's a link also to view member contact details. Anything that's missing or required to be not identified, the report will indicate as such. The next report is the member investments per portfolio report. This report gives you a summary of member investments per respective portfolio that they are invested in. The following report speaks about member investments per pot. And basically what happens is you'll be able to view the breakdown in an Excel spreadsheet of how much of money is split between the various pots in terms of either the vested pot, the retirement pot, or the savings pot, as is allocated on our membership records currently in terms of ongoing contributions allocations as well. Then we have the most commonly used report, which is called a totals per investment portfolio report. So this particular report gives you an overall summary of how much of money is held in the respective portfolios per respective employer. Okay, and that's all. That report is always available as of the last business day. One of the other reports that also we find has been frequently used is the savings claim submissions audit. So in terms of those members who do submit their two-pot savings claims, the reports are available for you to select between any period that you do prefer, and you're able to identify easily how many of your members have actually submitted their claims, what the status is on their claim submission in terms of two-pot, and also to see, in terms of the progress on the progress of those claims. So the report is updated daily, and obviously the information that you would see would be a day behind, and will indicate to you exactly the status of each of those claims as well. We have a report also which speaks about potential retirements, so you could extract the report to reconfirm in terms of your records the number of people who are due to retire within any specific period from 3 months up to 5 years from the selected date as well. Another interesting report is the outbound electronic communications report. So the fund basically issues all communication electronically, specifically with regards to benefit statements which are issued annually, and also with regards to any new joiners who come onto the fund in any specific period or any specific month. So the benefit statements, as I said, issued annually electronically to all members, and the youths be able to identify the date of when the report was actually, or those communications were actually sent out to those respective members. In terms of new members, as soon as we have received contact information from them in the form of an email address and a mobile number, the system will then automatically send out to those respective new people a detailed email, which will include links to download their membership certificates to confirm their membership to the Sanlam Umbrella Fund. We also have the digital user count report. So this report basically will confirm the number of users who are registered under that respective employer group. Gives you quite a bit of detail in terms of when those particular members registered, and also when last they logged into the platform as well. And for your perusal as well, there's also a living annuity member download report. So in the event of any members having selected an in-fund living annuity option, they would then be able to download the report and be able to view the details of those people as well. On the right-hand side, you have access to download an administration report or an employer report. And basically, the report is available for any 3 months under review. And you could select it per quarter or any specific 3-month cycle that you would like to view. And the employer report basically gives you an overall summary of the administration that's happened on that particular employer group for those particular months under review. We then have the pending claims report on the right-hand side of my screen. The pending claims report would basically confirm to you the number of claims that are outstanding in terms of where we've been informed of a potential exit of an employee, but no claims have been submitted. So this will perhaps maybe assist you in identifying, why a particular claim has not yet been processed on our side. We then have the claims in progress report, and the claims in progress report will simply just confirm the current status of any claim that's being processed, and the reasons as to why a particular claim is still outstanding or why it still needs to be moved on to the next step of the claim process. The claims paid report that also is automatically generated between any selected dates that you do prefer, and you'll be able to view details of when claims were paid, and also exact details of where those proceeds were paid to. Example, either to a member's bank account or to a portion to SARS in respect of taxation. Alternatively, if the benefits are paid to a third-party provider, you'll be able to see that information as well. We then also have the member beneficiaries report. This is quite a nifty report in terms of confirming to you how many of your staff members or how many members on the fund have actually loaded their online beneficiaries. So what we have found is that a lot of employers are using this particular report to specifically drive the online submission of nomination forms via the Sanlam member portal. The online beneficiary nomination comes in quite handy, especially at claim stage, and more specifically with funeral claims. So just to talk a little bit about funeral claims, in December 2021, the Long-Term Insurance Act was actually amended to remove the insurer's discretion with regards to payment of funeral claims. What this means in simple words is that members are compelled to nominate a beneficiary to receive their proceeds of their funeral benefit payment in the unfortunate event of them passing on. And in the event of there being no valid nomination, then the insurer is then forced to pay those benefits into the deceased person's estate. So there is something that perhaps maybe needs to be just driven hard with our members to ensure that they do update their beneficiary information as often as possible. In terms of the online beneficiary nomination tool as well, that tool is specifically available only to members for them to update their own beneficiary details online. So in the event of any member asking an employer representative or even the HR team to update their beneficiary details online, they will not be able to do it on the member's behalf. It is a security lock where members need to update their own beneficiary information based on their own circumstances, and changes to be made as often as they like. That's basically in terms of the reports which are available. In terms of there may be some highlights with regards to claim payments. So I'm not sure if you are aware, but perhaps maybe previously, prior to the implementation of the two-pot system, we were not able to apply for a tax directive, consolidated tax directive, to indicate to SARS, the differences in terms of payments in respect to the various pots of money linked to a member record. So initially, when the two-pot system was implemented in September 2024, we basically had to apply for a separate tax directive per respective pot. So if a member had a vested pot, which was the balance prior to 1 September last year, it was tax directive number 1. And once that tax directive was received, we were then able to pay out that portion of the benefit. Then came the second portion of the claim, which was the savings pot, which needed a separate tax directive because the taxes are calculated based on marginal tax rates, and that meant that we then had to apply for a second tax directive in order to pay out the savings claim. And then came the third tax directive, which essentially would mean that in terms of the retirement pot either being preserved in fund or being transferred to an alternate provider. And that means that then each claim basically was reprocessed 3 times over. So I'm pleased to confirm that SARS have done some enhancements to their systems, which allows us to basically now submit a single tax application to SARS, and our tax application would then include a split between the respective pots. So where we indicate to SARS, the differences between the retirement pot and the vested pot, and the option that's selected by the particular leaving member. The response from SARS would then confirm a single consolidated tax directive where we're then able to pay the claim immediately without having to revisit the claim multiple times, as was the case previously. So due to that enhancement, we're basically now able to improve on our turnaround times. Our current standard turnaround time is about 30 business days to process claims from date of submission. So based on the recent enhancement from SARS, we are looking to improve on their turnaround times, and there will be communication issued in due course to confirm our revised turnaround times with regards to processing claims. I would say revised and perhaps maybe more improved turnaround times regarding the claim processes. That's basically my overview with regards to the important points that need to be discussed as part of today's agenda. I'm going to hand over to my colleague Solly now, who will take you through to the investment presentation.
Right. Thank you, Abdul. Good morning, everyone. Yeah, we now turn our attention to the investments of the members, how they've done. So the investment returns on the investment investment portfolios. My name is Solitsi. I'm head of investment strategy within Sanlam Corporate Investments. And shortly, I will be joined by an exciting set of panelists to try and share insights with you. So just before we get into the investment performance of the portfolios, it often makes sense to just talk about the economic and markets backdrop in terms of how those affected the returns that members would have earned on their portfolios. But before we get into that, we just want to thank you on behalf of the Sanlam Umbrella Fund for the support that you've given us since inception. We've seen phenomenal growth because of the support and the trust that you've put in us, and also, as a function of how markets have done. So I'm pleased to confirm that as at the end of October this year, the assets under management that the Sanlam Umbrella Fund is looking after have reached 143 billion, which is more than 40% growth. So with that, we say we thank you. We thank all the stakeholders, the advisors, and also members, the joint forums, and all the stakeholders that are involved. Just to introduce the panelists today, I'm happy if they can show themselves. We have Marian Gordon, who's a principal investment consultant at Simeka Consultants and Actuaries, and also a branch head, and also Nompumelelo Kumalo, who's principal investment consultant at Simeka Consultants Actuaries. Welcome, Marian and Nompumelelo.
Thank you, Sally.
Thank you, Sally.
Yeah, so just to kickstart the discussions, I think a lot has been happening, and a lot of focus has been on what's happening in the US, predominantly looking at the domestic policy and how this has been affecting economics and also markets. As a consequence, we've seen some volatility. So I'm just wondering, when you see this picture on the screen, I'll start with Marian. Normally in an exam mode, you could be given something like this, and then you are asked to explain for a couple of marks. What's your reaction to this, what you see in front of you?
Yeah, I think my first reaction, Sally, is that Trump was the headline act for 2025. Between the big, beautiful bill, the G20 drama, the longest shutdown in US history, he really did keep market players on their toes. But I suppose out of all of these topics, the one I'll focus on a little more is tariffs. And that's just because it hits home a little bit more. the tariff strategy injected a lot of volatility into global trade, and South Africa is also feeling that impact. I mean, the 30% tariff that came into effect in August, it spares raw materials, but unfortunately, it hits high value sectors like the automotive industry and like agriculture, as an example. And so when you look at the latest data on how this has affected these sectors of our economy, what we've seen is that exports, in fact, vehicle exports to the US plunged by about 80% in the first half of 2025. But what is interesting is if you look at overall exports, we are up 6.7% year on year. So what that shows us is that there's been strong demand from other markets like the UK and European markets. So that's quite positive. Similarly, with agriculture, we're also seeing US exports to the US increase quite substantially in 2025, and that's despite the tariff shock. So there's a little bit of good news, but unfortunately, we're not out of the woods yet. Overall, the US makes up, or they are our third largest trading partner, and they account for about 7.5% of our overall global exports. So while the GDP impact is quite modest, there were estimates of about 0.5% impact. The strategic risk for South Africa is real. And I suppose the question now is, well, as South Africa, what do you do about this? And what we have seen is that SA's response has been quite proactive. We've seen quite a bit of diversifying into other markets across the likes of Africa, Asia, and Europe, and unlocking new opportunities. One of those opportunities, as an example, is the 90 billion rand clean trade and investment partnership with the EU. As an example. I mean, that type of partnership is a game changer because it does position South Africa as a competitive player in clean energy. And so, although there's, we are still expecting quite a lot of, turmoil from a market perspective, and we are expecting, a lot of volatility in markets as a result of the uncertainty of what happens to trade and tariffs going forward, we can see that South Africa has been quite proactive, and I think that is a positive story.
So Marion, while I still have you close to the mic, I mean, it's not just South Africa that has tried to navigate this tariffs issue. Other countries also had to navigate that. And it looked like, the country that was active is just the US, talking to everyone in the world, trying to get a good deal for themselves. And the initial proposals were not so pleasing. I mean, what do you think we could see in the medium to long term? Are we going to see maybe countries trying to do trade with each other, diversifying away from the US, or it's simply an accepted situation that the US is the largest economy, therefore it's important in everyone's life?
Yeah, I mean, I think we're already seeing that, Solly. I think we're already seeing quite a few new trade deals coming to the fore with other nations realizing that they do need to diversify their export base and the import bases. And so that's something we're already seeing. Even in South Africa, I mean, there's talks at the moment about agricultural imports to the likes of China. And so, these are, in some instances, examples of exploration that South Africa hasn't previously completely adapted to, and nor has a lot of other nations in the market or in the world. And so we do expect to see more deals coming on the table. But that being said, I mean, the US is a significant player in the global scheme. And therefore, I do expect quite a few countries to try to close their deals with the US while diversifying markets. I don't think there's a one-size-fits-all strategy in this.
It's just maybe turning to Mpumi while we're on the same topic. I mean, the initial tariffs announcements send shockwaves around the world, creating some sort of, definitely policy uncertainty when it comes to trade. What do you think is going to be the impact of that on global economic growth at a high level? Are we going to see lots of uncertainty, or is there something else that you can share with us?
Sure. So without a doubt, the moment those tariffs were announced, we saw so there are a number of indicators that we can look at to look at uncertainty, for example. The moment we saw those announcements made, those indicators went through the roof. So that already happened. But what I found very comforting was, and this is typically something you will see of markets in general, is that there's always that initial shock. Everyone is surprised and everyone typically overestimates the effect. So what you had when tariffs were implemented and reported was everybody started talking about growth as being dampened across the board, across the different regions. But what we actually found was that as time was going, and when I guess the US realized the reality of what they were doing, they actually had to backtrack on some of those decisions as well. And the realization was it's actually not going to be as bad as we thought it would be. Yes, there's still going to be an effect. So if you look at certain estimates, they were revised downwards at the initial reporting of the tariffs, but they've since been revised upwards, not to the previous high levels, but it's not as bad as everybody thought it would be. And that's typically a picture you generally see in our environment.
Interesting point you're making that, investors or other affected stakeholders tend to overreact. And you spoke about a couple of indications that show this uncertainty. So I'm interested specifically on investment markets, because I think we did see some reaction. What I'm looking now at on the screen, if we look at the returns over 1 year, we see equities on the JSE, South African equities doing for the year to date, 33% since 1 January up until end of October, and also global equities doing well. So maybe just explain the dichotomy of the two. We've seen stock markets that have done well, but yet we are painting this volatile environment in the economy.
I think when we talk about volatile, and that's a common misconception, everybody automatically thinks it's a loss. What we're talking about when we talk about volatility is that in general, people are not sure where numbers are going. We typically want a stable environment. So there is a bit of a disconnect between that word volatility and what you will sometimes see happening in markets. Now, for performance in terms of what we're seeing in front of us over here, if you and the audience will look at the second last row, that's resources. Year to date, they have returned about 95%. Now, two particular groups that have actually driven that's gold and platinum. Now, resources as a group have actually then filtered, that performance has filtered up to those 33% numbers you were talking about earlier. That type of strong performance, the first thing that I want to just point out, we're not expecting this performance to go on for the rest of the world. I mean, for the next 10 years. It is a point in time aspect. Gold, for example, the reason it's doing so well, demand has been so high because there's been a lot of uncertainty. So a lot of factors really coming into play, and the ability to move between those different factors really quite important. What was key to note, though, was at the beginning of the year, so in the first half of the year, offshore markets weren't doing so well. So with the announcement of tariffs, we saw a lot of investors moving out of the US and moving into other economies. So the US market wasn't doing really well. But it's actually since turned around, and that's where you're seeing that 22% number coming back around, right? So this experience of the double digits, very high double digits coming from offshore, that's what we're used to. What we're not used to is significantly higher double returns coming from the South African economy. But that really is a function of the environment we currently find ourselves in. Really, the implementation of tariffs and everything that has been happening in the US has had quite a material impact on markets and the numbers that you're seeing ahead of you. But what is key for me to report and to communicate is that investors shouldn't expect that this is going to be the way forward and a status quo from here onwards. It's not. It's a very short-term and interim effect that we're seeing.
Sure. Thanks for moderating our wishful thinking. We wish this could go on forever. Marianne, I'd like you to come in here. For some time, we've seen global markets outperforming South Africa and also emerging markets lagging behind. If you look at the year to date, and also these numbers are going to 1 year, emerging markets have delivered 22% yes in rand terms compared to developed markets that have delivered 10%. And then if you look at the South African markets, we have outperformed both the emerging markets and also developed markets. Are we seeing a reversal of the trend that we've been, become accustomed to in the past decade or even more? What's going on here?
That is a highly debated conversation at the moment, Sally. I mean, it's interesting you mentioned. So if you look at the year to date, emerging markets 22, MSCI, so the developed markets at 10%. But if you just cast your eye toward the right of the screen, you look at the 15-year numbers. For the last 15 years, per annum, developed markets have outperformed emerging markets by 7%. So yes, there is a big question mark about, is this the time for emerging markets to start flourishing? And a lot of this is around, demographics within emerging markets, the weaker dollar, risk on sentiment, all of these, and low valuations, of course, all of those being, good tailwinds for the likes of emerging markets. So this is quite a bit of a debate. And we have seen a few managers increase or start increasing their emerging market exposure quite considerably because they hold that view. Within South Africa, we're in a position at the moment where our valuations are quite attractive. So our South African equities and South African bonds, they remain significantly cheaper than developed markets, and that offers attractive entry points for investors. And so from our perspective, we do still have a bias toward local equities and local bonds from a return perspective. Do I think that emerging markets is also the place to be over the next decade? Time will tell. But what I can say is that the fundamentals are starting to look quite attractive for emerging markets, and therefore we are seeing quite a lot of interest.
Yeah, I thought I was going to resist getting into my favorite, topic, which is crystal ball gazing. But there you go. You've given me a hint to just ask that. So yeah, where should investors be focusing? Resources have run quite hard. Should everybody be piling into gold? Or, we've seen a reversal reversal of a trend away from developed markets to EM. Should people be looking at emerging markets? Or, local is lekker again. People should just be piling into the shares on the JSE. So I'll start with you, Marianne. Where should investors be paying attention?
Yeah, I'm going to cop out of crystal balling over here, Sally. And what I will say is that a diversified strategy wins all the time. And so there are these trends. And luckily for everyone on the call, we are dealing with asset managers that know what they're doing and that are actively monitoring markets. But even if you speak to one manager over the other, one might be very fully into the SA Inc. story and still believe that, SA Inc. stocks will do well. And others are avoiding South Africa to some extent toward, markets like the UK and Europe and emerging markets in particular. So we are seeing different views, even coming from our asset managers. I think what's important is to remain diversified and continue being invested in strategies that aim to provide you with that long-term wealth capital appreciation.
Okay. Mpumi, your view?
I am going to take a chance at the crystal balling just a little bit. I don't want to be a pessimist, but the reality, and now moving from a regional perspective, right? I don't believe that EMs is the new space. It might be short term, but the reality is that there are certain political and trade agreements that would need to be really dismantled for a lot of, I want to say, positives to emerge from the emerging markets. And for as long as those fundamentals remain unchanged, I will still remain a pessimist. But I 1000% agree with Marion around the importance of ensuring you have a diversified strategy. What we typically find in an environment like this, and especially as individuals, we will say, "Ooh, gold has done well. Now I'm going to go buy a lot of gold." But what we don't realize that as an individual, you're buying it at the top. And now what is the likelihood of that number shooting up even further? Highly unlikely, especially for something like gold. But like as Marion already said, you already have investment managers who have been looking at all of these dynamics already and have been timing their entries and exits appropriately. So I think it is also just about understanding the dynamics that are in operation. I still believe that at the short term, yes, local is lacquer, but I am still a proponent of having quite material exposure to offshore.
Yeah, that's quite interesting views. So I'd like us to turn our attention to what's been happening locally. And I think a point that will help us to do that is the medium-term budget speech, which is, hot off the press. Just maybe as an introduction, I mean, what it is, why is it important to us? Why is it important to the economy? So Mpumi, I'm not sure if you want to just give it a step and then
Sure.
Marion can come in later.
What is it? It really is about the government communicating to the rest to all of us, its intentions, how it intends on really driving those and implementing its intentions. So you want to see, when you say you're going to create jobs, how are you going to do it? That's what we're talking about over here. When you talk about you're going to create a resilient economy, how are you going to do it? Those are the types of things that come out in this type of speech. And it is very important because it allows individuals, it allows investors, it allows markets to get a sense of where a country is going. A lot of the investment decisions that are made based on that. Where do you expect an environment to progress towards? So if you look, for example, some of the points that have been outlined around the inflation targeting, the fiscal positioning, it's really garnered a lot of investor sentiment. There's been a lot of support because we are seeing a lot of direction. Very important because we do want to see that support in that particular area. So that medium-term budget speech really giving us some kind of direction. Where's that direction coming from? It's a roadmap really. And ideally, after the fact, you can go back and say, did we achieve everything that we wanted to achieve? It is quite a helpful tool in that regard.
Thanks, Mpumi. Marion, your reaction to the speech? Was it positive, negative, over-promising, realistic?
It seemed relatively realistic. I mean, if I had a one-liner, Sally, for this MTBPS, it would be that, South Africa is tightening the belt, but they're also trying to keep growth alive. And we're seeing that through the numbers. I mean, our deficit went down slightly to about 4.7% of GDP. That's the first time since 2008. And finally, debt stabilization is on the table. I mean, these are terms that we haven't heard for a long time as South Africans. But we also need to be real about it. Debt to GDP is still quite high. It's currently at 77.9%. So we're not out of the woods. But the good news is that the primary budget surplus is expected to expand quite considerably over the next couple of years. And then what we've also seen coming out of the budget, which was very positive, is the spending expected on infrastructure. So 1 trillion expected over the next 3 years. with private-public partnerships, of course, driving energy, logistics, and water projects. Those are all very positive for the South African economy. And so, yeah, the speech definitely sent the right signals. It sent the signals of fiscal consolidation, of stronger revenue, of reform momentum, and the markets liked it. We've seen bonds ease slightly. We've seen equity markets tick up, even coming into November. And so a lot of positivity, but I would say that execution is everything. And so without faster growth and without, private sector investment, these gains that we are seeing is quite fragile. And so let's see how the implementation takes place over the coming years.
Yeah, so what you're saying is that as South Africa household, we've been spending more than what we earn over quite some time. It looks like we're turning the corner. We'll be cutting back on expenditure, and over time, hopefully that comes below the income. And the deficit between, to sustain our expenditure, we've been borrowing based on that. So, I mean, it does sound like a positive story, but we're not a household. We also need to just grow the economy. You mentioned about the tension, stabilizing the debt, and also looking at economic growth. And one of the things that you mentioned was on infrastructure. 1 trillion rand over the next 3 years. The government doesn't have that much money. Where are we going to get it?
Yeah, so I mean, private-public partnerships have been the name of the game more recently. We've seen a lot of improvement in things like electricity because of renewable energy partnerships coming up, and so that's all quite positive. I do think that the public sector cannot do this on their own, and I do think it needs private sector support and private sector participation. And hopefully that expands significantly over the coming years. I mean, we've done a lot from an energy front, but there's still quite a lot to be done from a logistics component. And so, yeah, there's South African government has its work cut out for it, and I think that private-public partnerships are probably the best way to do that.
Bumi, you mentioned that this is also important for investment, right? Just to let everybody know what we're planning over the next while. And sometimes investment, well, that's an important part, is fueled by sentiment. And there's been a couple of things happening. We are off the grey list, etc. I'll ask you both. I'll start with Mpumi. What have you been hearing from people who track sentiment? How's the mood in the country? Is the sentiment turning for the better? Is it improving or not?
When we talk about sentiment, one of the things that has been coming up quite considerably is the disconnect between what we're seeing on markets, so the returns that you showed earlier, and what we're seeing on the ground. So a lot of people are saying, well, the markets are doing so well, but there's still so much high unemployment. And that really garners a lot of caution. It makes people very uneasy, and rightfully so. But what I would like to encourage people to keep in mind is that a lot of these initiatives, so for example, this inflation targeting, we're not expecting it to make changes tomorrow. We are expecting these changes to be implemented over time. And those positive changes that we are talking about, those are what we see a lot of the market saying, you know what, I actually believe in this particular space. So while there are certain apprehensions here and there, and rightfully so, because like Marion said, implementation is very important. You can tell me you want to do X, Y, Z, but I actually want to see it. I do feel that there is still a lot of hope. There's a lot of hope in what the managers are doing, even in terms of where they are looking for investments, really focusing locally. So it is a bit of a mixed bag. And when you actually rank South Africa against a number of countries, we are actually not doing that badly. fantastic. I know we sit here at home and we complain and we throw our toys, but I assure you, when you look at how we rank relative to other countries, we're not doing badly at all. So just to answer your question, more positive than negative, but the negative is understandable because of the realities that we're seeing on the ground.
Okay, thanks. Marion, your experience? Is there hope?
There's hope, Sally. I am seeing, not just from asset managers, but even if you look at sentiment as a whole, you are seeing it starting to tick up. And a lot of this, I suppose, is also just, I mean, it's rare for South Africa to have this good news rally. And we had a lot of good news over the last couple of months. We had an S&P upgrade. We had a firmer rand, although that was off a weaker dollar. We had, us being removed from the grey list. We're having this new low inflation targets, a lot of good news coming to markets. And of course, that does improve some of the fundamentals and the sentiment around South African markets. But I do want to say that, even if we're seeing this improvement in fundamentals, a large portion of the earnings on our stock market, on the JSE, is actually not rand-based. And so there's a lot of offshore earnings in our South African market returns. And so we've seen a fantastic year of 30-odd%, as you've shown earlier, but that's not directly related necessarily to the South African economic experience. And so we can be thankful that, despite some of the concerns that we have seen from an economic perspective in South Africa, that our members are still able to develop or deliver or have good returns over time. And so, yeah, I think we sometimes overplay our own concerns, and we forget that there's a lot of good news at the moment, and things like the MTBPS shows that there's still some improvement baked into the system over the next couple of years, and that's all quite positive. So there is hope.
Okay, just maybe a closing question related to what we've been talking about. I just want to get a view from both of you. How do we capitalize on the good sentiment, the hope that is emerging? How do we capitalize on that as a country to get the fundamentals right, like reducing unemployment, growing the economic pie or economic growth, and other things, to turn sentiment into actually better fundamentals? How do we do that as a country? Any one of you is welcome to jump in there.
I think from an entrepreneurial perspective, right? You want an economy that makes it easy to start off businesses, because starting off new businesses means new employment. What I found particularly encouraging about the budget speech was re-looking at certain reforms that didn't work. So the ability to look back and say, we didn't do this quite well, let's do something different. For me, those are the two very important things. Being able to correct yourself and making it easy for people to do business. I'm not saying completely make it relaxed and there are all sorts of infringements, but don't make it so difficult, especially for young and up and coming entrepreneurs, to actually implement their ideas.
Yeah, quite an important point. Thanks, Mpumi. Marion?
Yeah, I think there's a couple of things, Solly, that I think would need to be top of mind, and that would need to be improved to improve our economic growth over time. The first, there's 3 points that stand out to me. The first is to fix our energy, because at the moment, with high electricity costs, we're killing competitiveness. And so opening the market to private generation and trading could improve that growth in the short term. The second is around logistics. I saw an article the other day that said that our ports rank among the worst globally. And so that is something that would need to improve. In fact, I believe it was the Deputy Finance Minister who said that, if you just fixed logistics, you could open and unlock about 2% of growth. and stop billions in lost exports. So again, a fundamental area that needs to be improved. And then lastly, I would say fixing the municipalities. There's water losses in towns that exceed 40% in some instances. And so, unfortunately, you need private operators as well to assist in some of these concerns. And it all ties back to what Mpumi was saying. For individuals who want to start businesses and for current companies to want to expand operations in South Africa, these are things that will need to be improved to ensure that we remain competitive. I think the number at the moment is about 1.8 trillion. So businesses are sitting on about 1.8 trillion rand in cash. But unfortunately, they just don't have the confidence and the policy certainty to invest that in the South African economy. And I think if you start improving on some of these fundamental infrastructure concerns, you might start seeing that growth unlock over time. And that's exactly what we are hoping to see.
Yeah, thanks for the great insights. Also, always a pleasure to have you, and also to have a lovely chat. And I'm certain that the insights that you've shared will benefit everyone who've joined us today, and that will be useful. Yeah. So with that, I'd like to thank you again for your contribution, and then looking forward to seeing you in the future.
Thank you so much, Sally.
Thank you, Sally.
Okay. All right. Thank you. Given that backdrop that we've received from the panelists, we'll now turn our attention to the investment performance. Just to recap, in terms of what the panelists were saying, we've seen good returns all around across asset classes, both locally and also globally. So locally, the shares on the JSE for the year to date from 1 Jan up until end of October, 33.9%, over 1 year, 32.3%. These good returns have been filtering into the medium term as well, so 3 years and 5 years. So over the last 5 years, South African shares have been earning 20% every year compounded. And if you look over that 5 years as well, global equities, which are have delivered 17.1%. So that is shares listed in the developed economies. But emerging markets have lagged somewhat, delivering 8%. Compared to the short term that we have seen. So just in terms of the investment performance, certainly if you look over the short to medium term, members have done well, or member portfolios have done well. So to look at the investment returns on the portfolios, let us start with the default investment portfolios, and then we will finish off with the member investment choice portfolios. The Sanlam Umbrella Fund has 2 sets of strategies. So the fund has lifestyle strategies and also the protection strategies. The protection strategies are designed for members and also joint forum members who just want one investment strategy, no complexities, but they, in pursuit of simplicity, for members to be in one investment strategy throughout their lifetime. I will demonstrate on how those portfolios have done. The lifestyle strategy, this is for joint forum members who recognize that younger members are able to take the risk in pursuit of higher expected return, but close to retirement, 6 years before retirement, members in these types of strategies start being switched to what we call capital protection portfolio. So the capital protection portfolio explicitly provides protection to the hard-earned, accumulated assets over what we call preservation phase, where that's important because a lot of assets would have been accumulated over most members' retirement saving journey. Under the lifestyle strategy, there are 4 different options in terms of what members can be invested in during the accumulation phase, but all of them transition to one capital protection portfolio. So let's look at each of the portfolios, the accumulation portfolios, how they have done. So obviously the accumulation portfolio has delivered 18.9%, and the passive strategy has delivered 20% over the year to date, 1 January up until end of October. And the blue lifestyle strategy, 18.8%, the Sanlam Wealth Creation strategy delivering 17.4%. And even if you look at the longer term returns, so the 5 years and the 3 years and the 5 years, and even 7 years, we are seeing double-digit returns. And this is thanks to the strong performance that we've been seeing in the underlying asset classes. So it is pleasing to see that these portfolios have participated very well in the investment growth story that we have been seeing. It's also useful to keep an eye on how the funds are doing relative to what we would call competitors. So these are umbrella competitors. So the long-term return matters. Over the 1 year, yes, it is good for the portfolio to be in the top half of the ranking group, but performance can be everywhere. Our main aim is to make sure that the performance is good over the long term. And it is pleasing to confirm that, based on gross returns, like for like, the Sanlam accumulation portfolio is definitely in the top half when you look at the competitors, and also the margin relative to who's at the top is not that big. The Sanlam accumulation portfolio delivered 16%. And if you look at another default portfolio has done really well, which is the Sanlam Wealth Creation portfolio, delivering 16.2%. And over the medium term, over 3 years, the Sanlam accumulation and the Sanlam Wealth Creation portfolios have been in top positions as well. Looking at the passive strategy, the Sanlam, the Cetrix Enhanced Balance Tracker, which is the portfolio, which is the accumulation portfolio within the passive lifestyle strategy, has done really well over all these time periods. So over 5 years, being at top of the chart, and then over 3 years, delivering 19.5%, also strong performance there, and then being just above middle of the pack over 1 year periods. Now, let's look at the preservation phase, where all the accumulation phase portfolios transition to. Just an illustration, all the accumulation phase portfolios essentially go into what we call preservation phase from 6 years to retirement. Now, an important aim of this portfolio during this phase is the explicit capital protection, making sure that members don't lose any money while they invested in the capital protection portfolios. But now we also want that portfolio to retain investment performance that beats inflation. And we can confirm, if you look at the green bars on the screen, they are depicting inflation over different periods. So inflation has been 3.4% very low over 1 year, 4.2% over 3 years, 5 years, 5%. And the blue bars, each one of them represent the investment performance that has been delivered by the capital protection portfolio. So the Sanlam capital protection portfolio has outperformed inflation handsomely, and this is net of the guarantee fee that members pay while they invested in that portfolio. So that is a very good value add to know that, not net of costs, this portfolio is delivering value for members. I've explained why members will be invested in the capital protection portfolio close to retirement, but it's also important to note that the way this portfolio ends returns above inflation is because the underlying portfolio is invested in shares on the JSE, bonds, property, some private equity assets, etc. Just looking at the protection strategies set, is it pleasing to say that these portfolios have done well? Before I show the investment performance, we have the Sanlam Secure strategy, which is the most secure strategy in terms of the bonuses declared, etc. They are guaranteed. All of the bonuses are vesting. The slight difference between the difference between the two strategies is that while the Sanlam Secure strategy, all the bonuses that are declared there are vested, in the stable strategy, some of the bonuses are non-vested. What that means is that some of the bonuses that, well, those bonuses that are non-vested, Sanlam can, revoke them if the funding levels or if the market conditions are extremely bad or not conducive. But it is pleasing to say since 1987, when this portfolio was launched, Sanlam has not revoked all those bonuses. So something really, really serious has to happen before that. I mean, throughout the global financial crisis and the emerging market crisis, the COVID lockdown-related losses that we've seen, the Sanlam Stable strategy hasn't declared negative returns or revoked those non-vested performance. So it is good value for money, that portfolio. The volatility strategy adds 25% to the monthly bonus, just to try and earn a little bit more returns, so expose members invested in this strategy to markets. And when markets are doing well, we expect the strategy to outperform the other two strategies. And it's indeed the case. So because markets have done well, if you look at the returns of the volatility protection strategy over the last 3 months, they've outperformed the other two strategies. Over 1 year, they've outperformed. It's because of that additional 25% portion that is exposed to market risk. And if markets are doing well, this portfolio will outperform. Conversely, if markets are not doing well or maybe they're going sideways, the other two strategies are expected to outperform just because of the nature of the investment strategy. But I think what's pleasing is that in this time around, we've expressed inflation in the pink bars. All the strategies are giving members healthy real returns. So real returns are investment returns, and then you subtract inflation just to see how the purchasing power of your investments have done after you've taken off inflation. Switching to member investment portfolios. So the member choice investment portfolios are those portfolios made available to members who choose to opt out of their default investment strategies. We strongly encourage that members doing that, they do so in conjunction with their financial advisor, who would be able to help them navigate the choices that are available. So what's the menu looking like? So we have a wide range of portfolios, bucketed in terms of the risk profile, the most conservative portfolio available being SIM Enhanced Cash. So this is a cash money market portfolio. So this portfolio is designed to give you just a little bit better returns compared to what you'll get at bank, but the portfolio is the most conservative in the suite that we have. And then we have a range of conservative portfolios, moderate portfolios, and then also what we call moderate to aggressive or aggressive portfolios. And just to remind everyone, so there have been new additions that were done over the last 6 months or so. We communicated this at the previous session. So the Satrix Global Achiever Fund, and then also the Denka Sky Balance Fund that has been adding. So good set of opportunities that are there for members to select that, and also providing extra flexibility. For members that are that astute, we also have the Glacier option and also the Sanlam Private Wealth option, where members can do interesting things in terms of selecting their own shares there. Looking at the performance of these portfolios, we start with the moderately aggressive portfolios / aggressive portfolios. They've done well across board, double-digit returns. You see that the managers would have performed differently. This is due to the different positioning. So some managers would have had more shares compared to others, but overall, all managers delivered double-digit returns. And this is actually the case across all the periods. And just to illustrate the point that I was making earlier, that a manager that is top of the charts does not imply that, that manager or those set of leading managers are always going to be there. So it's not possible for one manager to outperform others consistently all the time. So having a mix of that manager in pursuit of diversification may help somewhat. But in terms of how to do that and when to do that, you will need the advice of an accredited financial advisor. Looking at the moderate and conservative portfolios, I'll start with the CM Enhanced Cash. So it's delivered 9% in line with where interest rates have been. So just a little better, but better than what we would have received from banks. But all other moderate portfolios have done well as well. Even over 3 years, if you look at something like the SMM50 portfolio, so this portfolio has half of its allocation into shares locally and also internationally. And the rest is also invested in what we call defensive assets, which consist of bonds. And because also bonds have done very well, this portfolio has delivered 16.3%. The same applies to the other portfolios that have done well. We've seen asset classes broadly doing really well. But with that, I'd like to thank everybody who joined us for their time. It is because of you we improve every time, and we rely on your feedback, on your support, and also the trust that you based on us. Thanks to all the stakeholders, so the members who've joined, the Joint Forum members, and also their advisors, and all the stakeholders that I haven't mentioned. Have a lovely day further, everyone. Cheers. Bye.